All right, here we go. Well, good morning. This is Bill Westmacott of Fivefold Financial. I've got my co-host here with me, James Longstreet from Calgary, Alberta. And of course, we've got our amazing guest, Florian Grummes, all the way from Germany. And we're really excited to have him on. I've followed Florian for actually many years, listening to him on major podcasts such as Kitco News, and of course with David Lin, who he's met in person in, I think, in Dubai, right? So, but anyway, we're excited.
Yeah, I brought him there actually.
Yeah, David's an amazing guy. He actually lives just down the road from me, well, in Vancouver, not very far. So anyway, so today, thank you also all the guests that are actually logging on right now, all the participants. We're excited to spend the next 45 minutes with you, with Florian sharing a lot of his insights and analysis. So I think to start off, Florian, I'd love to kind of get your big picture. What are the things that you're concerned about, or things that you're monitoring that, you think are important to highlight, and, just help people understand what's going on in the world today, in the world of economics and other trends that are concerning?
All right. Yeah. Thanks for having me. And hello to everybody as well here from South Germany, Bavaria. Yeah, I mean, there is a lot of things obviously happening, and probably the most concerning for each one of us is like the time quality, which is like intensifying and getting faster and faster our lives. So that's something that I honestly also personally struggle with. It's just like the amount of information that is bombarding us, the speed of things happening, the tensions that you meet everywhere, and you really have to work on yourself and make sure that you get into a higher level of consciousness. Actually, I think that's obviously also the key to it. Right. But that's like one of the biggest challenges, and of course. Part of it is also the challenges that we see economically and in the markets, financially, high inflation in many parts of the world, which affects 95% of the people at least, severely. If you have a lot of money, inflation is helpful to make more money. If you just live by your paycheck, it's killing you basically, right? Yeah. So that's something that is a big concern. Obviously, also the growing conflict between the East and the West, between China, Russia on the one side, and America, the NATO, and the Western alliance on the other side. Yeah. Unfortunately, there is no diplomacy anymore. There is no peace talk. There is just open, threatening even. I mean, it's the war in Ukraine is rather close here where I'm living. It's about 1,000 kilometers away. If there is nuclear war being fought, I will have a problem where I'm living here, So this is serious stuff. And the most concerning, again, is that you don't see any diplomacy. You don't see anybody in power talking peace anymore. It's only warmongers. Which also goes back to what I said initially, the quality of time and the question of how consciously you actually live in life. I mean, we are not supposed to kill each other, right?
Yeah, so, 100% agree. Yes.
That's a very concerning situation right now, and still many people here in Germany blindly follow the narrative that this war has to be fought with more and more weapons, and this is very concerning. Besides that, I mean, as I mentioned already, the overwhelming information and the speedness of things, the scams and the complicatedness of our digital electronic lives nowadays. I mean, AI obviously is supposed to help us, but I assume this will become a big threat very soon for us. Yeah. the amount of data that is being collected about each one of us, and AI knows much more about us than we know about ourselves, actually.
Yeah.
So and it's all automated, all on system, all on autopilot, and it's quite weird. And then coupled that with the idea that that central bankers pushing for a digital CBDC, central bank money,
Yeah.
which will completely put us into slavery, I think, is another massive concern. And since the financial system is insolvent since probably, I mean, at latest since 2008, but maybe already since the late 90s, when the long-term capital fund blew up, and the Fed started the first time really flooding the markets with money. So the system is insolvent. However, it still incentivizes all the people in power or in charge of that system. So they're all trying to keep running it, continue to running it. And the only way forward to not let it implode would be to come up with a CBDC kind of system and force us into something where we cannot escape anymore.
Yeah.
So that's also a big threat that I see.
So, yeah, and I mean, to your point about conflict, even this morning, another massive attack was sent against Israel. So we're seeing war expansion too. And, you know, if you follow market cycles, Florian, which I'm sure you do, you probably understand the cycles. But yeah, we're in a war cycle on top of it. So, you know, we had another war breakout in Europe, or on the border of Europe a couple of weeks ago, and now another war potentially could get very serious. I suspect Monday morning the markets might be quite interesting, depending on how this unfolds in Israel. You know, with this massive attack against them, they're not going to take this lightly. And we know that, unfortunately, the regime in Iran has instigated this, funded this. So and I agree with your point, Florian. I mean, I've never seen such incompetent or corrupt politicians around the world. We have no statesmen. We have no one that wants to actually bring solutions. They seem to want to continue to stoke the fires and cause more crisis. And to your point, it's overwhelming sometimes with so much information, so many things going on simultaneously, trying to get your head around it all, right?
Right.
Yeah. So I, like you, I follow the markets pretty closely, and as well, James. So, you know, but so, you know, what I'd love to transition. I mean, you've made some very valid points, you know, in terms of things to be concerned about. Ultimately, too, we want to get to solutions towards the end, what things that people can do, maybe some ideas that you can share with them. We also want to make sure guests can ask questions. So if you have a question, at the end, we will address those. We'll get Florian to answer those for you, and probably take 10, 15 minutes or however long. We'll try and wrap this up in about an hour. So Florian, I would love to, you just did another major conference. That's one of Florian's giftings, is be able to present, and he's sought after in many different areas, economic, you know, in the resource sector as well, crypto. So why don't you share with us for the next, say, 20 minutes, a series of slides, stuff that you think that's really important for our guests to grasp as far as trends, what are things we should be very aware of at this time. So I'll hand that over to you, Florian. Take maybe 5-7 minutes per slide, or 3-4 minutes, whatever you feel comfortable.
Right. Yeah, thanks, Bill. I mean, I have actually quite a few slides here, but
oh, sure.
I hope I will make it in about no more than 30 minutes. Okay.
Okay, sounds good.
So can you see my screen? Is this working?
Yes, I can. Yeah.
All right. So I called it my little presentation here for you guys, roller coaster.
Yeah.
And not because Oktoberfest just finished a few days ago here in Munich, where you usually can ride a roller coaster, but it's obviously more in reference to what I think we have to expect in the markets over the next few weeks, months, and years. And I think also going back, we can see like that we actually have been already through quite some roller coaster over the last 20 years. And that basically the Fed is responsible for this, so the Federal Reserve Bank in America. Obviously, I have no crystal ball, and you have to take responsibility for your own results. I'm cooking with water like everybody else. Yeah. But at least I'm doing this for quite a few years, nearly 3 decades now. All right. So let's start. You can see this chart, Bill, the federal funds target rate.
Yes. Yeah.
And you can see my mouse as well.
Yes. Yeah.
Okay, excellent. Good. So this is obviously the interest rate of the United States of America. It's not a free market decision where the price of money is, but it is basically a fixed decision by a few, mainly old men behind closed doors, who believe that they have enough knowledge to understand the highly complicated economy and markets and come up with a decision of the price of money, which I find itself totally absurd, because it's just so complex to get your head around this three-dimensional, ever-changing puzzle. But it is what it is. We have to still accept it. I hope at some point in the future we will come to a point where this is not important anymore, but right now it is still playing a big role, and unfortunately the whole world is still watching those people, and obviously the Fed's fund rate. So in October 1981, the federal funds rate was at 20%. Yeah. And you had a 40-year downtrend, basically. And in March of 2020, in the Corona crash, the interest rates in America dropped to 0.25%. Historic low. Money was super cheap, basically free, and a massive drop over the 40 years, which sparked obviously a huge boom worldwide, especially in America, in all the Western countries, but also in emerging markets, everywhere, basically, because money got so cheap. And since then, the interest rates have spiked up, and now in September, the Fed raised it to 5.5%. So what they have been doing over the last 1.5 years, basically using the sledgehammer, okay, from 0.25% up to 5.5% in 1.5 years, more or less. That's crazy, unseen, never happened, unprecedented, that speed. And interest rates are up 21 times in less than 2 years. It's unbelievable, and we don't know how the markets really will react to it in the mid to longer term. Obviously, they broke something already in March and flooded the markets with a lot of new money. But if we go back in the past, and this is the same chart again, highlighting the rate hikes that they did in the past, and every time they hiked, basically, a recession followed. Yeah. Okay. So it's very likely that now that they have hiked like never before, we're going to see a recession rather soon. So my assumption is we're going to see a recession in the next 3 to 12 months, probably. Germany, where I'm living here, is already in a recession. I think for America, it's just a question of time. And I think that we're going to see most likely a hard landing. If you go back and look here at this chart again, so every time they did this, they created a lot of problems in the economy. And even if there was no official recession, if you remember, this hike here, for example, created the Asian crisis, which then led to the Russian crisis, which then led to the blow-off of the long-term capital fund in the late 90s. Yeah. Which basically was the first time that forced the Fed to flood the markets with huge amounts of liquidity, and which then lead to that final blow-off top in the internet mania of the late 90s. So it's always the same story in the end of the day. And I assume that, again, within the next few months, up to 12 months, we're going to likely see a recession for America. And as I just mentioned before, this is the bank term funding that they came up with in March when 4 regional banks, rather large banks, went bankrupt very quickly, and you had a bank run in America.
Yeah.
And the Fed over one weekend came up with a $400 billion bailout, new base money basically created out of thin air. And it took them 48 hours to pivot back then, because the pressure was growing so much. On a Friday evening, I think Mrs. Yellen said, like, no, we're not going to do anything. On by Sunday evening, they basically agreed to bail out the whole system with the 400 billion new base money. So that's basically where big banks can turn in their bonds and get a loan for it on par, meaning even if the bond is down 40 or 60%, they can still get the initial price that they basically paid for it on par, and keep that loan for a year. So it's going to be interesting next March when these loans are coming due. That was basically a first break in the system in March, and they came up with a huge rescue package which carried the markets into the summer. But if we look further now, the interest rates keep rising, and we just closed at 4.8% for the 10-year US yields. It's a rise of 1,368% since March 2020. There is no liquidity anymore, obviously, in these markets. Otherwise, yields wouldn't rise that much. It's quite a challenging setup. The same is, by the way, true here for the German 10-year Bund yields. I mean, you can see 2.9% is still way below the situation in America. That's also one reason why the dollar has been so strong, the difference in the yield.
Yeah.
But also in Germany, the yields are rising sharply, and 2.9% are up 420% since the low in March 2020, when, by the way, we in Germany had a negative interest rates. So if you had more than $100,000 on your bank account, the bank would charge you 0.25 or 0.5%. It's unbelievable. But now you get at least some money for it again. But of course, real interest rates. So if you subtract inflation, it's still negative real interest rates, right? You're parking your money with the bank. They pay you 2-3%. Inflation is at 4, 5, 6%. You still lose purchasing power. So that's the situation. And of course, with these rising yields, the value of those bonds are falling and falling and falling. And it's this was the first leg down, which ended last year in autumn, nearly a year ago, and now we're seeing the next leg starting again. The question really is basically who has these losses on the book, and I can tell you, for example, I showed that chart many times because I thought it was like, still think it was a trade probably of the century when the Austrian finance minister sold a 100-year bond of Austria, right, at 1%. So basically, Austria lended money for 100 years at a 1% rate. Obviously, this bond now is down, I think, 75%. Wow. And this is not something that retail investors have been buying. This is something that pension funds have been buying. Institutionals in Europe have this crazy bond in their portfolios all over the place. So asking who has the losses on the books, it's lots of institutional banks holding a bond portfolio completely underwater. And of course, you can hold this until maturity. In the case of this Austrian bond, you still have to wait 98 years to get your initial money back. and so it creates a lot of stress in the system. And there is no easy solution to that. If we look further, here is the iShares TLT ETF. You can see after the financial crisis in 2008, when they started lowering interest rates substantially, this ETF went up quite a lot. It went up nearly 100%. And now since late 2020, early 21, it's coming down severely. And it's now at levels unseen since 2007. Again, this gives you an idea of what's going on in the worldwide bond markets. And I think that what we're seeing here is a world bond collapse. Okay, we are now seeing, I think, 8% mortgage rates in America since a few days, since last week. So this is creating a lot of stress. And at the same time, all the central banks, or most of the important central banks, like the Bank of England, the Bank of Japan, the Federal Reserve in America, the European Central Bank, they're all still tightening. So they're trying to reduce their balance sheet. And at the same time, they have increased the interest rates. So it's a crazy tightening in that situation. And central banks continue to speed up their balance sheet reductions. At the same time, all this excess liquidity that has been in the system, first of all, because we have seen since the financial crisis in 2008, lots of money printing, lots of balance sheet expansion, actually. So the Federal Reserve balance sheet, as well as the balance sheet of the European Central Bank, for example, is up 10 and 16 times, I think. And then also this massive money printing due to the Corona lockdown had created excess liquidity in the system, which is basically wobbling around looking for opportunities. But if you look at this chart now, you can see that basically 80% of the US households have no savings anymore. Oh, and they basically spent all this in the last 12 to 15 months. Since the reopening, obviously many people wanted to catch up and also just enjoy life again. But they spent more than they should have done. And as you can see, 80% of the US households now have depleted savings, which is a very, very tricky situation going forward into a tightening economy. At the same time, we have US bankruptcy fillings at record highs, last seen in the Great Recession of 2008 and in the pandemic in 2020. That's certainly not healthy. At the same time, credit card delinquencies are through the roof, higher than basically 1992, which was the highest level. Also, not a good chart, actually a very negative one, showing in reference to the chart before where you can see that the savings are depleted. I mean, this is actually exactly confirming that. Then looking into towards Germany quickly, I think the same is true for America, obviously, but looking at the German real estate market, for example, you can see the construction PMI index is down significantly since the top in late 2021, early 2022. And the real estate prices in Germany are down significantly over the last one year, more or less. Right now, when I talk to my friends in the real estate industry, they confirm that there is basically nothing moving. There's no sales. There's just nothing happening. It's basically in freeze mode. And you can withstand that maybe for a few months or half a year, but at some point, I mean, there is a lot of jobs depending on that sector. And the real estate sector is not as important in Germany as it is in America. Right. So a lot of jobs depending on it. And I think it's exactly the same picture in America now.
Well, Florian, it's even worse in Canada. So we have double the amount of GDP in Canada is actually tied to real estate, double of the US. So it's even worse.
Right. So and it's not just like that real estate agents and real estate developers suddenly don't have any business anymore, but it's also the whole construction business that basically is part of it. I mean, there's a lot to it. So the real estate market here in Germany is in a freeze mode, and it's the same in America and in Canada. So and that is obviously due to these high interest rates. Now nobody can afford a house anymore. Yeah. And maybe on the paper it looks like prices have not come down that much, but it is probably just because sellers still trying to hold on and somehow trying to avoid to sell right now. But if this whole situation continues and they will be forced to sell and more people are selling, then I think prices will come down even more significantly. So that was a quick side view on the real estate market. And looking at the stock markets, you can see that officially the S&P 500 had a good performance over the last 12 months. But if you look at the Magnificent Seven, which are Nvidia, Meta, Amazon, Microsoft, Apple, Alphabet, and Tesla, it's mainly to those 7 stocks that the index is up, while most of the other stocks are flat or actually down. So if you would look at the Russell 2000, for example, it would give you a much more true picture or reference to what's going on in the economy. And the Russell is going nowhere and is not looking really good in technical terms. So you can see the black line or dark green line here. This is like basically the S&P 493 without those 7 magnificent stocks, and the green line is the one with those 7, just those 7 stocks. So it's quite a distorted kind of picture, and obviously is misleading what's actually really going on in the stock market. And another warning flag, and I can just urge the viewers to take a look at these links here. Nvidia, it looks like there has been done massive financial engineering in the background to basically come up with these unbelievable positive revenue numbers and growth profile. This is some really good articles showing that there is some really sketchy people in the background engineering stuff.
No, that could never happen, Florian. What are you talking about?
So it looks like Nvidia could maybe become the Enron of the 2020s. I just would suggest to take a look at these 2 articles here to get an idea. And I also suggest, like, don't believe the hype. Obviously, AI has the potential to change our lives, also to the positive, also to the negative. We have to see how this all plays out. But I think that the expectations and the big hype about AI and Nvidia, that basically was also helping to keep the stock market up until the summer, you have to be very skeptical of that. Okay. All right. So bringing this all together, I think the only question is how much currency will have to be printed.
Yes.
Okay. So I obviously have no crystal ball. I don't know how long this whole thing can continue without a big implosion or a disaster or a crash or more spikes, whatever. I don't know. And I cannot really tell you exactly how it will play out. But I think we are on the way to a credit freeze. I think we are on the way to more severe problems in all markets. And it's all connected. It's all about liquidity. And it's all about trust, obviously, as well. You can see that bond markets in Japan are breaking now. The currencies are breaking there. And it's a very tricky situation. And I believe at some point, the Fed will have to come up and print again. This time, they will have to print more than ever before. That's a very, very important principle to understand. If you look back the last 25 years, every time they had to come back to the market and rescue the market, they had to print more money than the last time. Okay. So if you take the numbers from the Corona crash and the Corona rescue package, it will be much bigger than those numbers again.
Wasn't the number
exponential? So I think they will have to come up with most likely trillions and quadrillions, right? And it's hard to say exactly, but we have, I mean, the whole system is insolvent. We know that there is a huge derivative market that nobody really understands actually what's going on. And so that will happen. Right now, we have the situation that I think Powell and his colleagues took their mistake very personal when they called inflation transitory. and they will do everything right now to look like they are very hawkish, and they now make sure that inflation is being fought, and that the markets believe in the Fed again. But I don't think that they will be able to turn this around. And obviously, this has been building up over decades and decades. So it's not only Mr. Powell's fault. It's like building since the end of the gold standard. And already the gold standard, the end of it was because the system probably back then was more or less insolvent when the French asked the Americans to basically send the physical gold for their paper dollars to France. And the Americans realized, like, oh, wow, if we continue to spend more than we are making, we will run out of gold. So we have to stop the gold standard, right? So I don't see that there's any other way. The only question is, like, how fast will it happen? And I mean, we learned in March that this can take a weekend, all right? That's also something to understand. Okay, so that's basically the assumption or the conclusion here. More than ever before will have to be printed.
Yeah.
And how can you save yourself? I think the best ways to save yourself against that kind of messy situation will be gold and Bitcoin, or let's say precious metals and Bitcoin. And this is the two asset classes that I have been focusing on here with my company, Midas Touch Consulting. I'm now 23 years in precious metals personally, and 10 and a half years in Bitcoin. So I have quite some experience. Still, the markets managed to surprise me, but I think this two asset classes, analog, old school, shiny rock, 5,000-year-old history, always been money, always survived any dictatorship, any war, any mess, any craziness. Doesn't need electricity, doesn't need internet, doesn't leave any traces. It's amazing gold. I think will always keep its value, and maybe it's not going to be the fastest horse, but it will be a stable one, the one that you can rely on. And so that's, I think, especially when it comes to conservative part of your portfolio, I think that should be play a very important role in your asset allocation. And the other one, obviously, is Bitcoin, decentralized, a new technology, basically a new bookkeeping technology, scarcer now with the next halving than gold. There's only 21 million. In the age of internet and a digital world, you need to have some form of internet electronic money. This network cannot be stopped or controlled. Yes, they can forbid Bitcoin and they can stop the on and off ramps, but Bitcoin itself is unstoppable. And I think over the next decades, more and more people will wake up to that fact. And obviously, once they come up with trillions and quadrillions, Bitcoin will most likely be the fastest horse again. Yeah. So I strongly believe that those two, analog gold, digital Bitcoin, complement each other like yin and yang, basically, like winter and summer. It's a great mix. And so that's why we at Midas Touch Consulting focus on those two asset classes.
Well, Florian, you've given us a lot to think about. So right now, so let's just maybe nail it down a little bit. So you've talked about major inflation. You see now it's interesting, if you study history, there's been two major inflationary cycles in the past, in the last 100 years, one being after World War II, 40s, and then as well in the 70s. Now, it's very interesting, to your point, you believe, and I 100% agree with you, that they will, at some point, probably when something really breaks, they will do a massive injection of more liquidity into the system. But the end result will be what? More inflation. And so if you study those two periods, there was actually 3 waves of inflation. And the third one in both those cycles, in the 40s and the 70s, was the worst. So people have an idea, this is all going to go back to normal, everything's going to be wonderful. So I tell people, you need to be very defensive right now, and you need to protect your capital. So do you have any other ideas for the viewers of ways to protect your capital? Like Warren Buffett's famous saying, he has two rules around money. One is don't lose my capital, rule number one. Rule number two, don't forget rule number one. So, so what would you suggest?
Look, I mean, if we still have some time, then I could also then go through some more charts specifically on gold and Bitcoin. But first, to your question, obviously, structuring a portfolio is a very individual
Correct.
kind of, right? It depends on how much money you have. It depends on how much experience you have. It depends on your personal favorites. It depends on how much time you have to manage it. It depends on your age.
Yeah.
Et cetera, et cetera, et cetera. And some people love to do everything with ETFs. Other people just want to own stocks themselves. Some people prefer real estate and the real estate income. Gold bugs obviously always have a very high portion of their wealth in precious metals and everything related to precious metals.
Yeah.
If you talk to Bitcoin Maxi, he will tell you should just hold Bitcoin forever.
Yeah.
I mean, there's a lot of ways, obviously, and it's something that again, it's a very individual approach every time.
Yeah.
But I think 10 to 25% of your money in physical precious metals is your safe bank. It's your safe haven. It's like something that you just put away. You don't have to worry about it. Yes, it goes up 5 or 10% or comes down 5 or 10%. Now gold is down 12 point something percent since May. But still, it's all manageable, and you will always be able to cash in your physical gold if you need money to pay for something, or if you see an opportunity in the markets. Being outside of the financial system with a part of your assets makes a lot of sense. So physical gold, I think, is a very important part. I also like real estate, generally speaking, simply for the real estate income. However, the own house that you live in is actually not an asset, but it's a liability because it costs you money all the time and it makes a lot of work. And it's like once you have a house, many people who don't have a house always believe that this is like the big goal. But once you have one, you realize like how much work it is, how much money it costs you all the time, and how unfree you actually are, and how little the time that you really can enjoy it. But of course, the psychological part, like in terms of security, having your own, owning the roof above your head, is playing a role. I understand it, and I'm not against it, but you have to like put it where it is. It's actually a liability and not a real asset, your own house. But if you have rental income, generally speaking, yes, I like that. But what I can see in times of financial repression, that it's becoming more and more hard to make a good return here.
Yes.
And they make it so difficult nowadays. And again, I mean, in German, you say not real estate, it's Immobilie, which means you're immobile. You cannot move around. So you're stuck in a place, and it's actually quite complicated to get rid of it. I'm not a huge real estate fan, but I'm also not against it. It really depends on jurisdiction, right? So that's what I would say to real estate. I'm a big fan of dividend stocks, so especially commodity related stocks like, for example, Rio Tinto or BHP Billiton, which pay a really nice dividend where you can basically create cash flow on a quarterly basis. That's something I like. I'm also liking a lot the whole oil and the uranium sector. Not in the very short term. I think oil is now probably running into another wave of correction over the next few weeks and months. But in the larger picture, I think that oil most likely will go much higher. And I also think that uranium has a lot of potential to go higher in the next few years. So those are two sectors where I also like to own stocks. But my main focus when it comes to the stock market really is in like nice dividend yields. And if you do your homework, you will find a lot of those, and you can diversify yourself all over the world. I'm not a fan of ETFs. I'm completely avoiding ETFs. I somehow don't trust the banks. I think we've seen a few times already that when it comes to stress in the system, the ETFs don't really track the underlying basket of stocks. And I'm not willing to give away my ownership of these stocks to a bank, and then I own some form of a promise by a bank, while the bank actually is using my right to vote at the annual shareholder meeting, which I think is actually a very important part of the whole thing. And that's why BlackRock became so powerful, because they can use these rights at an annual shareholder meeting, even though it's a passive ETF that they're just managing. Somebody has the rights. It's not you anymore. So that's why I avoid ETFs. And what else? Of course, Bitcoin is a great add. You have to be very careful what you're doing there in terms of altcoins and all these potentially interesting, promising looking things, which quickly can turn out as a scam, or you just send your money to the wrong wallet, or you trusted a wrong exchange. There's so many mistakes and errors that you can do. You have to be very careful. And you also have to understand that altcoins usually don't come back. In the next bull market, it will be a new set of altcoins. So these pullbacks, which we are seeing right now in the crypto world, in the altcoins, up to 99%, I mean, they probably will never recover. A few of them, but the vast majorities of these 20, 30,000 altcoins that we have now will disappear. Same what we have seen with the ICO wave in 2017. And focus on Bitcoin, I think it makes a lot of sense. Maybe adding for speculation a little bit of Ethereum and Solana. Okay, maybe not at this moment right now, but generally speaking, yes. But I'm only interested in altcoins when I can see that we are in a confirmed new bull market, and I don't think we're there yet. And by the way, the same is true for mining stocks. When we talk about precious metals, I think it's not the time to own a large amount of mining stocks at this moment, because it's also a very speculative asset class. Once gold clearly has turned around and rallies and starts also to break out to new all-time highs, yes, then you want to be invested in mining stocks. Right now, we are still in a risk-off environment. This can change within a few days, as I've talked about before. When they come back to the market and print like crazy, this can change in a weekend, but it could also drag on for another few weeks, months, maybe into the first or second quarter next year, until really something breaks. Who knows? In that period, you don't want to be invested in all these super risky speculative assets. You want to mainly hold cash. Short-term bonds maybe is okay. And just wait, and your physical gold, you can sit through these pullbacks, but mining stocks will suffer a lot. So
good input. Hey, James, did you have any question for Florian before we open it up to the floor? So if the guests on the webinar would like to start asking questions, we'll actually address that in the next few minutes. But James, did you have any specific?
Sure. Yeah, Florian, thanks for everything that you shared. Very, very insightful, a lot of value. Florian, how would you describe? Of course, cash has a place in every portfolio. There's many needs for cash, but for the average person, if you're holding cash that's 2 to 3 year time horizon, or over 2 or 3 years or longer, how would you describe the risks of doing that today versus even as little as 10 years ago? The risks of holding cash today versus what 10 years ago?
Yeah, I mean, obviously the big difference now is that we have a much higher inflation than 10 years ago. At least, I mean, now we have it officially. We all know that the felt inflation has always been higher than the official numbers, right? And if you were looking at your medicine bill or your insurance bill, it's been going up relentlessly over the years. but this hedonistic statistic approach to inflation numbers is generally speaking very questionable. And if you look at Shadow Stats, John Williams, I mean, he's publishing the numbers like they would have been using the formulas from the 1970s, and we would have much higher inflations over the years already. But coming back to your question, officially 10 years ago, we had nearly zero inflation, between 0 and 2%. So the loss of purchasing power by holding your cash in the bank account was probably neglectable. Now at 5, 6, 8, we saw in Germany at some point 10% over the last year, it becomes a big factor. And if you go grocery shopping, you can see that many items are up 100%, 150% even. So of course, parking your money in as a liquidity in a cash account is also a position in the market, and it's one that you can appreciate if you're able to do that. First of all, because as we've seen, 80% of the households in America don't have any savings anymore. So that's the first thing. And it's also a position that you can hold for a few weeks or months or half a year just to sit out that messy situation out there, right? But at some point, you will lose purchasing power. So I don't think it's a good idea to hold cash for the next 10 years, maybe for the next few weeks. Once you get the signal, they are back into printing mode, you have to change and you have to allocate quickly, I would say.
Yeah. That's great, Florian. And I think that's the key. What you said is, you know, you can't have a buy and hold mentality anymore. You have to be willing to be nimble and change asset classes as markets can change, as we've seen very quickly. Hey, James, can you see the first question?
Sure, yes. First question here, Florian. What do you see the effect of the end of the petrodollar and potentially the Fed at a macro level? What will replace it? Assume it's not CBDCs.
Yeah, it's a good question, and it's a question that is on many people's mind nowadays. I think you have to differentiate, right? The end of the petrodollar means that the Saudis are now selling their oil not only in US dollars, but also in Chinese renminbi, and they can go to the Shanghai Gold Exchange, use their renminbis over there to buy physical gold. And that's obviously more interesting to them nowadays, as China has become more and more significant player. We have to see how this all plays out. If America is trying to walk the same way as the Chinese are doing, meaning an authoritarian, centralized, rather socialistic system, the petrodollar is gone and America will lose because the Chinese are far ahead when it comes to such a system. If America remembers its true powers, which is freedom, a free market, then I believe there is probably a good chance that even the end of the petrodollar will not bring the end of the US dollar and the leadership of America. And that is a big question, and I'm not sure if all the politicians in America are really aware of that. So it's mind-boggling how many people you run into in your life and they still haven't understand why socialism doesn't work. So anyway, the petrodollar will of course lead to some form of new currencies, but is this a process, I think, that takes decades? It's probably not an event overnight, as maybe many expected. It will take decades, and it's a slow shift. Still, right now, most of the emerging markets are highly indebted in US dollar. That's also one reason why the US dollar is so strong. There's basically a squeeze. So this is a rather complicated story. But I think that gold will play a more and more important role because the Saudis don't trust the Chinese don't trust the Indians. I mean, you have to also recognize that, look, China has big problems right now. China is basically somehow actually at war with India. South Africa, also part of the BRICS, is a broken country. I mean, they're completely depending now on their resource exports to China. And the only significant new player in this whole thing is Saudi Arabia. While Russia, for example, is taking anybody as a friend that they can get nowadays because they're so isolated from the Western world. So it's not really a power team right now, the BRICS. In terms of population, demography, and economic power, yes, they have a better outlook than most of the European and Western countries. But I think this is a long process, and the only important takeaway is that I think gold will play a significant role in this whole decoupling from the US dollar and the end of the US petrodollar.
So you'll see some form of a partial backing of either commodities or gold as a major force. Of course, we've seen the largest purchasing of gold by central banks. They know another crisis is coming. Clark has a follow-up question. And so maybe we try and make it a little bit quicker because we got a couple more questions. This is also assuming the BRICS is not the long-term answer. You've kind of somewhat addressed that already. There's a lot of chaos in many of these BRIC nations as we speak. But he says, do you see more localized valuation and currency that is backed by something physical? Again, you've partly answered that. What might it look like? So how will this new currency emerge? How do you see it unfolding, Florian?
I mean, to be very honest, I don't know exactly how this will unfold, but I think what's clear is that the world is getting more fragmented. It's not that we have this one superpower, America, in the future, but we have a new superpower in form of China, and they have more and more influence. I mean, I think they have massive influence over Africa already.
Yeah. Central America or South America as well.
Yeah. So there is a lot more competition going on, and yeah, again, I mean, what we see right now is that they try to establish more trust into the renminbi, and if they do this by basically offering the convertibility of the renminbi into physical gold via their gold exchange in Shanghai, that's a very smart way that might go on for a few years before the world has developed more trust into that currency. Again, I think the one common denominator will be that gold will play a more important role in this whole thing.
Yeah.
I don't think that China and India want to have a currency together. That probably will not happen. Very unlikely, actually, but there is a uniting or factor, and this is basically the hate against America, right? And I mean, America has done really everything to create a lot of haters on the planet over the last few decades. So
yeah, it's true.
Yes, I mean, locally, regionally, I mean, gold plays a significant role in China already, right? And it's the same in India. And I mean, China is the largest gold producer, is also the largest gold importer. India and China together are responsible for more than 50% of the gold demand. The most gold probably is hoarded in Indian temples. These are the two countries that will basically dictate the price of gold in the future. And whenever there's diminishing trust, gold will profit from it. So,
yeah, no, good point. James, you want to get on to the next question?
Yeah. So next question, I'll ask the question for, and then I'll just rephrase it in a way that I think that he's asking it. So Frank is asking, what will digital money do worldwide? And another way to ask it, I think, is Florian, what do you see as the impact of, in a few years, if we have central banks globally simultaneously all rolling out central bank digital currencies? What do you see the impact of that being?
Yeah, I mean, it depends. If theoretically they would be able to align it with each other and come up with one digital coin, like a world coin, so to speak, it would be very, very dangerous. At the same time, I think it's probably impossible because it's just too complex and there's too many people, interests, countries, economies, etc., etc. And usually states don't attract the smartest people in terms of programmers and coders and creative people who need to basically come up with all this. So you've seen the Inagra, for example, failing tremendously. It was everything else than a success, and they had to roll back. But if they somehow manage to implement such a system, and even if it's in the Eurozone or digital or a CBDC Euro system, and they do something similar in America, yeah, I mean, it's programmable money. They can basically decide when you have to use the money, until when, the price of the money, how much you can use, if you are allowed to use it or not. It basically takes away all the freedom, and it's a total nightmare. It's a total dystopian nightmare, and I can just encourage everybody to wake up and stand up against this. This is really very, very dangerous.
Thanks, Florian. Hey, we'll just jump to the next question. And so again, this is from Clark. Let's assume that this is the end of globalism, communism, socialism, fascism at a world level. That's quite the statement. What will global currency and banking sector look like if you had a guess? So if we actually had an end of this totalitarian, heavy-handed, fascist type of system control, Denise's dream, what would you think a global currency or banking sector would look like if we could get rid of the totalitarian dictators running it right now? The cabal, as it's called.
Well, I don't know. I mean, that's a very difficult question, right? I mean, the only one that would work instantly is Bitcoin. So everything else, I mean, that's always one of the arguments of the Bitcoin maximalist. You cannot send around millions in gold very quickly, right? I mean, Bitcoin theoretically could be the solution in that case. I mean, since we all believe in free markets, we should appreciate and simply let the free market figure out. The free market is much more intelligent than me and anybody else. So the swarm intelligence of the free market will figure out what is the best, and it could be that it's quite a back and forth, try and error kind of process, but it would probably be a better result in the end of the day than what we're seeing right now. So it could be actually quite messy in the beginning.
Yes, I would probably agree with you on that. Messy is a good word. James, you want to ask the next? This is from
last question here we see right now, and then we're getting close to the top of the hour. So how long is the actual strength of the dollar, meaning US dollar, going to last? Do you see a scenario where the euro is going to rise against the dollar? And I'll add to that, if you can comment on this as well, Florian, the relative strength of the US dollar. Would you say they're, all currencies are kind of like skydivers, so they're just falling at different paces? So you can comment on that as well.
Yeah, I would agree with your last comment. But the US dollar is still a better fiat currency than basically all of the other fiat currencies, right? And if you look at the problems that we have here in the Eurozone and in the Euro system, I mean, and I mentioned this before already, the debts that are in US dollar nominated out there are crazy, and these are countries not being, and people and companies not being able to print their US dollars. This is only America that can do that. So I think that the dollar against other fiat currencies, generally speaking, should do okay or well. I mean, there is also up and downs. I think the dollar had a tremendous run over the last few months. Actually, since the financial crisis in 2008, the dollar is stronger against most other currencies. It's not stronger against hard assets like gold or against stocks or against Bitcoin or against your real estate, right? So against those asset classes, the dollar is down heavily, but against other fiat currencies, the dollar has held up rather well or is actually much stronger. And I would assume, generally speaking, that this should continue. However, if the Fed will stop raising rates, which I expect they probably have stopped already, or they have reached the top already of their hiking cycle. But once they have to lower interest rates dramatically, I think that the difference between the interest rates, which I showed you before, like in Europe, you have the German 10-year yield is like a 2.9 versus 4.8 in the US. So this difference will get smaller again, and that would probably be also a driver for a stronger euro and a weaker dollar. And the dollar is very overbought now, and I assume that once the Fed is back to printing, the dollar will weaken against certain fiat currencies like the euro, for example. But if you look at a fiat currency like the Turkish lira, for example, I don't think that the dollar will ever weaken against such a crappy fiat currency. So
Yes.
You have to be really careful against what you compare it, right? So against hard assets, against dollars, against gold and precious metals, against mining assets, against stocks, dividend stocks, against real estate, over the years, the dollar will weaken and lose more and more power. Against other fiat currencies, it should be rather stable. While if the Fed will turn around and start lowering interest rates, I think against the euro, the dollar will also see a severe weakness for a few months or maybe even a few years.
Yeah. Thanks. So, I want to respect your time, Florian, as well as James and all our guests. This will be recorded on my YouTube channel. If you just go to my name, Bill Westmacott, or I'm not sure, it might even be under my company, Fivefold Financial. One of the two, I can't remember. I'm not on YouTube. I watch YouTube all the time, but I don't post a lot on YouTube. But I really want to thank you, Florian. And if anyone wants to learn more about Florian and what he does, go to his website at midastouch-consulting.com. And Florian does help many clients all over the world and helps them make better financial decisions. So thank you so much, Florian. You did a great job presenting really a lot of key things that are going on in the world today. And so, and again, thank you, guests, for asking questions. We really, in fact, Clark said he really appreciated your answer. So he said, thank you for that. So, and so do we. So, as they say, I guess it's nighttime there. So guten Nacht, schlafen gut. That's about all I know in German, other than Mach schnell and a few other ones. But no, I hope you have a good rest tonight, Florian. And thank you so much for doing this for us. And we look forward to seeing you more in the future on many, quality platforms. So thank you so much.
Thanks for having me.
Really appreciate it. Thank you.
Avita saying.
Take care.
I got a few in my sleeve, a few.
Take care, everybody.
All right.
Thank you.
Thanks,
Bye.
everyone. Okay, bye. All right. Well, thank you so much, Florian, again.